enable.
Hello and welcome to a brand new edition of the Financial Advisor Forum 2016-17, brought to you by UTI Mutual Fund and CNBC TV18. This time we come to you from the city known for its delicious biryanis, Hyderabad.
The Financial Advisor Forum 2016-2017, presented by UTI Mutual Fund in partnership with CNBC TV18, reaches out to independent financial advisors across the country. And this time the forum travels to Hyderabad to discuss and strategize how financial advisors can scale up their business, reach out to millennial investors, and embrace technology to serve their customers effectively. The mega theme for this forum is Unexpected is the New Reality. Financial experts and industry leaders discuss the mega trends and market themes and share their insights with the independent financial advisors in an engaging and interactive session. The forum experts are Suraj Kale, Group President Sales and Marketing at UTI Asset Management; Nimish Shah, Head Wealth Management at SBI; Shashi Bhushan, CEO Way to Wealth Brokers; and MS Shabbir, MD Sensage Financial Services.
Unexpected is the new reality, and perhaps nothing could be more relevant and more pertinent than the theme of the forum this year around, because unexpected is what life has almost come to be, right from the 8th of November, actually 2016, demonetization, the way US markets are going, US election results, interest rates, there's just a whole lot going on. So how does the IFA community meet that challenge and make sure that advice is relevant and it's pertinent to the ever-changing market reality? Let me throw it open with some brief comments from the panelists themselves. So I'll start with you, Shashi.
Unexpected is the way of life. You have to accept it, actually, because the nuances of each of this has created space for itself. Be it the one she picked up on demonetization, the realities of the markets, the realities of the global impacts on each of these exercises, I think has formed a trend, and I'm sure it will be the way ahead also.
Mr. Kale, you've been sharing insights with the audiences in other cities. Now it's time for Hyderabad. So unexpected is a new reality. What do you think are the components of this volatile sort of period that we're talking of?
Well, I think the unexpected world really started with, I would say, Brexit. Because that was the first time, when all of us were very surprised that, actually Britain will opt for Brexit. And then we had Trump. On the same day, we had almost the demonetization that is coming through. And the most hilarious one is, we were worried about the US Fed hikes, markets going down. And latest I hear is that because US Fed will rise, rates, the Dow Jones is touching new highs. So obviously there are a lot of components around, which are, I think, shaping the world today. And that's why we believe that unexpected is the new reality. But I would add one dimension, which is, I think, very unique. In the last 2.5 decades, I have really come up with the view that if you want to beat inflation, you need to, buy into equities. But for the first time, RBI's fight with inflation is for real. And if RBI maintains inflation rates at close to 4%, and banks were to offer 6% and funds could offer a little higher in debt, my sense is that for the first time, you could really generate your wealth by investing into fixed income. So it is, which I think is a big surprise, because we always talk of equity as the vehicle that generates, wealth. So of course, equity will still outperform fixed income, but I think the role of fixed income in generating wealth, I think is a very big unexpected for the next 3 to 5 years, or maybe coming decades as we go ahead. So I think that's a big change that I'm observing.
But Nimish, let me get your opening remarks.
Sure. So, I think uncertainty is the only certainty in life. And the theme is all about, understanding where this uncertainty comes from. But I think the underlying aspect which every one of us has to really believe is that the markets in which we are investing, how confident are we of that, right? We have seen some structural changes happening in the economy over the last few years, right? What is going to be the impact, and how we can really manage the volatility, right, by being more positive and taking advantage of what volatility throws at us rather than being afraid of volatility and running away from it. So managing risk in this time, I think, is going to be most crucial, and that's where I think we should really focus on.
Okay, Mr. Shabir, first thoughts?
Unexpected reality. Unexpected reality, when we talk about it, let's look at it. The unexpected is something which volatility is something which is inbuilt in the market itself. If life were as we wanted it to be, then probably there is no meaning in life. So if unexpected is there, what are the unexpected things that can happen now? For example, the markets, the brokers have already been saying that the target for the 2017 has already been achieved in the first 2 months itself. If you look into the outside scene, there's a discomfort, mounting discomfort in the Eurozone. So these are some of the uncertainties which are there. The market is for the advisor to find out how he can manage the wealth of the funds and hold the hand of the investors. That's where the role comes. And I think as an IFA, as a distributor, there's no better time for the investors to hold the hand of the investor, or the advisors taking the hand of the investors and holding them together. This is the best time. That's how I look.
Given the different moving parts, I mean, equity, as he mentioned also, markets already Nifty looking pretty lofty at 9,000 odd, or almost at 9,000. The way debt is moving, the way physical assets have behaved after demonetization, what's an ideal mix?
So, that's where, what I mentioned that, managing volatility through understanding risk is very crucial, and therefore, as advisors and, whether, we are talking to individuals or, even HNIs, the idea is to understand what is the risk appetite. And risk appetite is a very varied subject where, perceptions can differ. But having understood that not taking a risk is a risk. Right, and therefore, a lot of people are actually, to what Suraj mentioned, that avoiding equity at a higher valuation is not necessarily a smart move. Right, equity again is a long-term perspective, and therefore, whether the index is at 8,900 or it is at 7,500 should not make a difference as far as allocation to equity with a 3-year perspective is concerned. And therefore, I feel the right way to go is to look at the asset allocation, make tactical calls depending on how the volatility is kind of affecting the various returns and asset classes. But that's where I think the way forward is that strategic asset allocation standard. But tactical asset allocation level, you need to kind of make changes as you go ahead.
Okay, Shashi, your thoughts on this challenge of how to allocate how much, given the volatility?
See, if you look at the traditional piece, people always have gone for safety, as he rightly was mentioning. What is the extent at which a customer decides for himself? What is it driven by the advice? I think the forum will completely acknowledge that irrespective of what and where he puts money, the IFAs are a very, very important connect. And IFAs are people who kind of get them to in that direction. So getting to the myth of should it be done on a personal level or should it be advised, irrespective of the mode and fashion where they get details from. If you go 20 years back, you had so much lack of information in anything you do and everything you do. And today we are here. We have every second a WhatsApp or a communication tool which is reaching you all that data which you want, but you're still not able to decide what you want to do. So in this clutter of too much data versus no data, okay, no options versus too many options, I still believe that the first two critical things, which, as Nimish was mentioning, on self-imposing the risk appetite measurement is very, very critical. What is the extent of risk you can take, based on which the asset allocation can happen? There is no shortcut to asset allocation. It has been traditionally preached by all of them. That will continue to happen. What is the fight? The fight is not to lose relevance of this advisory piece. And that for years to come, you have that when you go to a doctor, you always want a second opinion. Whether they go through the digital medium or wherever else, I think the advisory role will be absolutely in place. And as and when they go progress, that data assimilation which they do and distribute it to their customer through the new age devices, I think will define a lot of things. So that's the way forward.
So let's talk a little more about fixed income.
Yeah.
Given where interest rates are, and it's a big debate now whether the best of the rate cut cycle is over, whether we'll see a pause or we'll see a hike next. what sort of funds should one be in? The classic question, duration versus accrual. What's the right way to go looking at the cycle?
Yeah, no, again, as an asset class, fixed income is not as well appreciated. So for example, markets you track on a daily basis, so you know which stock is going up, which stock is going down. But interest rates are not that simple. So if I've asked individuals questions like, do you know which are the top 5 securities in my debt fund? And most of us may not be able to answer. But if I talk about equity, almost everybody will know the top 5 stocks that we have in our fund. So first of all, it's a very little understanding of that space there. Second, I think from a mutual fund perspective, we offer products where probably we do business for free, like liquid funds, where we don't have any expense ratios, to, charging as high as 200 basis points in some of the funds. So many times you may take a credit call or even a duration call, but if the expenses of the fund take away that return, then that's not a great deal for the investor. So my advice generally has been, if you don't really relate to fixed income as much, start with probably accrual products on the shorter side of the spectrum. You can look at FMPs as a good category because they are the nearest to a bank FD that we have, and because of the low expense ratios, actually you might make a return which is superior to even what a duration fund can offer over a 2 to 3 year period. So I would say if you stay at the shorter end and do accrual products, I think you will be better off as far as fixed income is concerned.
Mr. Shabir, your thoughts on, generally the kind of trends that you're picking up from Hyderabad? Are people more comfortable with direct equity, mutual funds? Is it more about SIPs, lump sums? Are people looking at STPs?
See, when it comes to investment in the asset allocation, I think as an advisor, we should not the first key thing is the risk profiling and engaging the customer and trying to find out where he stands today. And then from there, hold his hand and take to which point do you want to take. For example, from my experience, I can share that a lot of people who have invested in post offices who have been coming back to us and asking whether can we do something because of the taxation, 1. 2, because they're insisting on the Aadhaar card to be given, which now they fear that all the long accounts will be linked. For them, the solution that we give is we ask them to either to get into MIP or a debt fund or maybe an accrual fund or maybe a balanced fund where there are a lot of fund houses who have been allowing 10% of the units, without any exit load. The advice that we give them is if you were getting, let's say, the bank rate of interest is 6%, you'll be satisfied with 6%. 6% after 20 years also the bank will give you the principal amount. Here, probably the amount could increase only if you are prepared to take the interest rate which the bank was giving. That's 1. 2 is that people who are into fixed asset, as I said, we convert them into it and do the allocation and show it to them that rebalancing is a key. You should never get away from the rebalancing kind of a thing. Probably every quarter, every 6 months, you need to see whether you need to do a rebalance and do it. At this point of time, when there's uncertainty outside, when the interest rates, the Reserve Bank of India has got a hawkish move, what we feel is there could be one interest rate hike. Having said that, the best time could be to get into the gold allocation, not to get to reduce the gold allocation below 10%, and then start an SIP in that allocation, get into a accrual fund, and then depending again on it's not one solution, give it equity risk. So equity, debt, and gold is that what we believe in, and gold we still continue to have a 10% allocation with an SIP because we feel that will give you something. I think if you can give a little balance for newcomers, we start with a balanced fund. That's what we feel, and we are comfortable with. Give a balanced fund, that should be fine.
Okay, Shashi, any thoughts on the debt equity?
I think the question would always remain how much and where. As he was mentioning, once you do the profiling, you get a good hold of what that customer needs, which they are all experts in. Age measures a lot of things. Risk appetite allows you to flexibly put things in place. Having said, I think the larger question today is where do we find the community? Who needs an IFA or an advisor in the first place? So I think that can be kind of a little bit more mentioned, where you have the new age kids coming from the tech zone, coming from biotechnology zone, who think life is all about a credit card, and I'm sorry to be stating so, expenditure is first on their mind, but not an investment. So that is one cult which the IFAs should target. The other piece is the retirement piece, which a lot of people lack planning onto the retirement side. So I think these are two important aspects which each of them should kind of get to.
how can one actually reach the younger investor quicker, faster, and more efficiently?
There's a new generation which is coming up which does not want to see the face of an advisor or anybody else, who want to buy everything online. So they would, like they buy on Flipkart anything or Snapdeal, they want to buy even their investment products online. Now, obviously, the challenge for us is that we've never been geared up in terms of trying to communicate with this audience. And so I think one of the things which, at least at UTI, we are very conscious of is that the language in which we really demonstrate our, we come and talk to them has to change dramatically. You have to get more friendly, more youthful. You have to be somebody, where they can relate to. You have to relate to examples, which they would find exciting. So, for example, if in, let's say, 20 years back, I would sell a fund by saying, prepare for your retirement, long-term 20 years, this doesn't excite the young audience. You say, okay, you want to go your holiday 3 years down the line? No, here's a way you can do an SIP in a fund. So you have to start the same concept, with an example which is there, and then take him to say, by the way, you'll also retire, you'll have a quality of life that you need, and hence you need to also do a pension plan, and you need to save, and, do some retirement planning. I think the sequence which you use also would change very dramatically. So at least we believe that you need to create a seamless way where you can just come probably to any website and then on an intuitive basis able to relate to your product. I think that's what will be the need of the hour.
Client acquisition is one thing, retention is another thing, and building those relationships and ensuring that in this cluttered marketplace and a very loud and noisy marketplace, how do you remain relevant? How do you ensure that you stand out in the client's mind and obviously, in the work that you do?
The IFAs at a point in time should get the actual details of what they want to advocate to the customer from the cluttered noise which is all over the place. Now, new pension scheme, while it's not the most remunerative product from a IFA's perspective, but trust me, it is one of the best products for an individual. So now that is where the differentiation is. Today, I mean, with all bankers around, and that may not be the first advocation of the biggest bank or the bank the customer deals with. But that could be an advocation coming from you because they have not heard about this from anyone else. So well-made products, well-guarded products, kind of preached products are the ones which need to reach their customers. And importantly so, the regulation has made one such product which is in this NPS. So the moral of the story is keep getting to those unknown, unidentified, good investment product like Mr. Shabir was mentioning. Even today, his customers want to go and put money into the bank, into the post office. May not be remunerative to you, but when you add those small little, percentages in your, customer portfolio, definitely that will add greater stickiness in retaining those customers.
Okay, Nimish, you want to sort of come in on that?
So I think customer retention is definitely something which all of us will always strive for. And one tool which I know which has been used by IFAs, but I think more important, there are two things I would like to highlight here. One is in terms of the belief, which I think many times lacks within the advisors themselves. When I talk about advisors, it's not only IFAs; it's everyone, right? The belief in the market in which you're operating. That sometimes lacks. So, for example, we talk about equity allocation, but how many of us are really allocated to equity to the extent that we should be as per our risk profile, right? So, that belief, unless that is actually coming out when you're talking to clients, right, it doesn't translate. And secondly is remaining on top of whatever is happening in the economy and whatever information that you need. The analytical tools which are now available in the through the digital platform, I think that's how to maximize the use of those analytical tools and the data which is actually coming out of it, how to interpret the data and how to apply it to a client's portfolio. I think that's going to make the entire difference as far as the stickiness to the client is concerned.
Mr. Shabir, closing thoughts on this?
I think IFAs need to prepare themselves. One is instead of being an IFA themselves and trying to do a solo advisory, I would suggest that you collaborate yourself and then make a team instead of running solo. The reason for that is that there is a competition which is very big. So you will not be able to scale your business, or you will not be able to scale your business and the business that you're doing it. And the market is very big. Second is that you need to have the solutions that you have, not just technology for yourself, but for your investors also, and that should match. CRM is an integration is one important thing that I would say that you need to integrate. Third is that you need to, CRM is one, and you need to read. What I find the IFAs is that they do not spend time in reading. I think that's a very important kind of thing to see what the market changes are happening. If you want to find out what is unexpected, then probably you need to change on a daily basis and probably have a mentor, a senior person who will be able to guide you and then discuss. You should have forums where you should be able to discuss for retention of the clients.
Okay, all right, Mr. Kele, then final thoughts. Any advice, any tips how to remain relevant and stand out in a difficult market?
The first one is, I think we are at a very rare moment in our economic journey, where I think not only is this business a big opportunity today, but is going to accelerate at a very rapid pace. So I think mutual fund distribution advisory is at a very, very sweet spot. So I think that one opportunity which comes, I've been 2 decades and I think this is the best time I've ever witnessed. The second thing is this will always remain a trust business. Never give up your customer centricity, and that I think remains very crucial. And the third and last point is adopt technology as your friend, because that will make your life simpler. And being an investment business, you always have to skill yourself and remain relevant. If you lose touch with the investment world, you're out of this business, because the clients are expecting you to be their expert in investments. And if you don't invest in that yourself, I think you will never be able to serve your clients very appropriately. But if you put these 3 things together, I think, perhaps the best times ever.
That's it from this Financial Advisor Forum here in Hyderabad. We'll see you again in a different city with another distinguished panel of experts to explore new opportunities in financial planning. Thank you for watching.
Focus, ideate, innovate, enable.